This is Monday, April 13th, 2026. And if you're just waking up right now, you need to understand that the world changed in the last 12 hours. Silver touched $72.69 per ounce this morning. That's a $2.91 gap down from Friday's close. But this isn't just another price move. This is the direct result of a geopolitical nuclear bomb that detonated at exactly 10 a.m. Eastern Time today. The U.S. Navy has officially begun a blockade of the Strait of Hormuz. Right now, as I'm recording this. And I'm going to tell you exactly what I'm doing about it, because what happens in the next 7 to 9 days has never happened before in the history of the silver market. Let's start with the facts. No rumors, no speculation. Just what U.S. Central Command has confirmed themselves. April 13th, 2026, 10 a.m. Eastern Time. U.S. forces officially implemented a blockade of all maritime traffic entering and exiting Iranian ports. This blockade covers both the Arabian Gulf and the Gulf of Oman. CENTCOM's official statement is crystal clear. Forces will begin implementing a blockade of all maritime traffic entering and exiting Iranian ports on April 13th at 10 a.m. ET. But here's the twist. This is not a full closure of the Strait of Hormuz. The U.S. Navy is only blocking Iranian-bound vessels. If a ship is transiting through Hormuz to non-Iranian ports, it's being allowed through under strict naval monitoring. So technically, the Strait of Hormuz is partially open. But practically, the oil supply has been completely choked off. Why? Because Iran produces 1.5 to 1.7 million barrels per day of crude oil, and that entire production has just been cut off from the market. And it's not just Iranian supply. Saudi Arabia confirmed that Iranian attacks reduced their production capacity by 600,000 barrels per day. So add it up. Iranian supply loss, negative 1.7 million barrels per day. Saudi supply loss, negative 0.6 million barrels per day. Total daily loss, 2.3 million barrels per day minimum. And Columbia University energy analyst Karen Young told CNN, "We still have the problem of a shortage in the market of about 7 million barrels of crude, 4 million barrels of product not getting out. It could be a long time from now before oil prices come down, even after the war ends. 7 million barrels per day shortage. To put that in scale, the world consumes roughly 100 million barrels daily. 7% of global supply just vanished. And this isn't just about oil. This is directly connected to silver. So here's the question. Everyone's asking, if oil is trading at $105 per barrel, why is silver falling? Because people think war equals inflation equals silver goes up. But in 2026, the reality is the exact opposite. Let me walk you through the mechanism that's playing out in the market right now, step by step. Step 1, oil spikes. WTI crude oil opened today at $104 to $105 per barrel. That's a 9.3% jump overnight. Brent crude crossed $100 per barrel, up 8% in a single session. This is the highest oil price since March, and it's a direct result of the blockade. Step 2, inflation expectations explode. When oil moves this fast, inflation projections get immediately revised. U.S. March CPI already printed at 3.3% year over year, which was a massive jump from February's 2.4%. But if oil stays above $100 for the next 4 to 6 weeks, April and May, CPI could cross 4%. Fox Business analysts are projecting core CPI at 2.9% by May to June. Step 3. The Fed cannot cut rates. The Federal Reserve's mandate is price stability. If inflation is running at 4% plus, the Fed cannot cut rates, even if the economy is slowing down. Right now, the market is pricing in only a 30% probability of a rate cut in December 2026, and that's just one 25 basis point cut. There will be no rate cuts in 2026. Step 4. The dollar strengthens. When the Fed stays hawkish, meaning keeps rates high, the U.S. dollar strengthens. Today, the DXY dollar index rose 0.4%. That might sound small, but for silver it's fatal, because silver is a dollar-denominated asset. When the dollar strengthens, silver becomes more expensive for foreign buyers, and demand drops. Step 5. Silver's paper price crashes. And finally, because silver is a non-yielding asset, meaning it doesn't pay you interest or dividends, when the U.S. Treasury 10-year yield is trading at 4.3% to 4.4%, institutional investors sell silver and shift into bonds. The result? Silver opened at $75.90 on Sunday night in the Asia session and crashed to $72.69 by Monday morning. This is the inflation trap, the mechanism that retail investors don't understand. War leads to oil up leads to inflation up leads to Fed staying hawkish Fed leads to dollar up, and dollar up leads to silver down. But that's only the paper price. The physical market is screaming the exact opposite, and that's the most dangerous part. When silver was touching $72.69 on COMEX this morning, The Shanghai spot premium was 18.72%. What does that mean? Chinese buyers were paying $86 per ounce for physical silver, while the paper market was showing $73. That's a $13 difference. This isn't arbitrage. This is desperation. Because China knows that physical silver is not available long term. Let's look at the registered COMEX inventory. In February 2026, registered silver stood at 86 million ounces. At the 2020 peak, registered silver was 346 million ounces. That's a 75% decline in inventory in 6 years. And this is the 6th consecutive year of a supply deficit. The Silver Institute's official estimate for the 2026 deficit is 67 million ounces. But independent analysts are saying it could go as high as 245 million ounces when you factor in China's export restrictions and the sulfuric acid ban. And that acid ban? China has already announced that sulfuric acid exports could be banned starting May 2026. This is critical because 70% of newly mined silver is a byproduct of copper mining, and sulfuric acid is essential in the copper heap leaching process. No acid equals less copper, which equals less silver supply. So, on one side, the paper market is crashing due to leverage and margin calls. On the other side, the physical supply is structurally collapsing. This divergence has never been this wide. Now here's the most chilling piece of information I'm going to give you. JP Morgan Chase commodity analysts officially confirmed on Sunday the last tanker to clear Hormuz on February 28th is expected to reach its destination around April 20th, marking the point at which pre-closure barrels are fully exhausted from the global supply chain. April 20th, 2026, 7 days from now. What does this mean? When the war started on February 28th and Hormuz was mined, the last oil tanker that crossed the strait that day will reach its destination on April 20th. After that, every barrel of oil the world uses will be post-war shortage oil. Pre-war inventory is gone. Strategic reserves have already been deployed. The IEA released 400 million barrels in March. That covers 4 days of global supply, already exhausted. If Hormuz doesn't significantly reopen by April 20th, oil could hit $120 to $150 per barrel. And at that point, CPI will cross 5% plus, the Fed will consider emergency tightening, a recession will be officially declared, and silver's paper price will test below $60. But physical silver? Demand will be at $100 plus because currency crisis mode will activate globally. This is the exact scenario that played out in 1979 to 1980. After the Iranian Revolution came the oil crisis, and silver went from $5 to $50 in 18 months. History doesn't repeat, but it rhymes. Now here's another shocking detail that mainstream media is not covering. U.S. intelligence sources confirmed during the Islamabad peace talks that Iran was using the ceasefire to replenish weapons. The quote, Iran was using the 5-day ceasefire window April 8th to 13th to replenish certain weapon systems with key foreign partners. So, while J.D. Vance was sitting in the negotiation room for 21 hours, Iran was restocking missiles and drones. This wasn't a ceasefire. This was a rearmament window. And now the Iranian Revolutionary Guards have officially warned any military vessels approaching the strait will be considered a ceasefire violation and dealt with harshly and decisively. U.S. Navy destroyers are in Hormuz right now doing mine-clearing operations. The USS Frank E. Peterson and USS Michael Murphy are confirmed on active duty. If Iran fires on a U.S. warship, and retired Admiral James Stavridis estimates that Iran's anti-ship missile capability is still 60 to 70% intact, the ceasefire ends instantly. Trump resumes airstrikes within hours. Oil spikes to $130 plus instantly. And silver? It tests $65 the same day because algos will immediately sell on dollar strength. But physical buyers, they'll be lining up at $90 to $100 because they know this is the last buying window. There's another immediate threat that could activate in the next 24 hours. A CME group margin hike. Right now, in April 2026, the COMEX silver futures initial margin requirement is 18%, which was raised from 15% in February. But look at the history. January 7th, 2026. CME raised the maintenance margin to $32,500, a 47% increase in 1 week. January 13th, 2026. CME switched to percentage-based margins that automatically scale when price rises. January 30th, 2026. The same day as the margin hike announcement, silver crashed 30%, the worst single-day drop since March 1980. CME's Rule 802 states, the board can change margins at any time without notice. But practically, CME follows a pattern. Sunday night or Monday after close announcement, effective from Tuesday's close. Today is Monday. Silver had massive volatility, a $2.91 gap down. Oil is up 8%. Stocks are down 500 plus points. These are exactly the conditions in which CME justifies a margin hike. If CME announces Tuesday evening that margins are going from 18% to 20%, here's the math. A 5,000 ounce COMEX contract at $73 equals $365,000 face value. 20% margin equals $73,000 per contract required. Current 18% equals $65,700. The difference is $7,300 additional collateral per contract. If a trader holds 10 contracts, which is not even a large position in the futures market, they need to immediately deposit $73,000 in additional margin. If they can't, forced liquidation. And when forced selling starts, stop loss orders trigger, price cascades down, and the death spiral activates. This is the exact playbook that ran in January 2026, and silver went from $121 to $61 in weeks. I'm personally monitoring the CME website Tuesday evening. If any announcement comes, I'm immediately adjusting positions. So now the real question, what am I doing? First, I am not panic selling physical silver. The physical silver bars and coins I own, I'm not selling a single ounce. Why? Because dealer buyback prices right now are $64 to $68. So if I sell today at a $73 spot price, I'm actually taking a $5 to $9 loss per ounce before silver even moves. And the replacement cost? If I want to buy silver back in 2 weeks, I'll be paying $83 to $85. Spot plus $10 to $12 premium. Round trip loss, $15 to $20 per ounce. That's stupidity. Physical silver is insurance, not a trading instrument. I'm holding. Second, I'm watching the $70 support level like a hawk. $70 per ounce is a critical technical level that's been tested 4 times in 2026. If silver breaks $70 on a daily close basis, the next support is $62 to $63, which is the 200-day exponential moving average level. $62 is still fair value historically. It's 100% above early 2025 levels, so if $70 breaks, I'm not panicking. I'm looking at selective buying in the $62 to $65 zone. Third, I'm scaling into miners, not silver futures. Silver mining stocks are undervalued right now compared to the silver price. First, Majestic Silver cut guidance by 11%. The stock is already priced in the worst case. Fresnillo reduced guidance by 9%, but it's still the largest primary silver miner globally. If silver structurally settles at $80 plus by the end of 2026, which is the median of every major institutional forecast, miners will give you leveraged plays. I'm dollar cost averaging into mining ETFs, specifically SIL, the Global X Silver Miners ETF. Fourth, I'm not touching leveraged silver ETFs. ProShares Ultra Silver, ticker AGQ, which gives 2x daily leverage, is a death trap in current volatility. If silver falls 5% one day, AGQ loses 10%. If it recovers 5% the next day, AGQ is still at a net loss due to the compounding effect. Leveraged ETFs are intraday trading tools, not buy and hold investments. I'm completely avoiding them. Fifth, I'm preparing for a $62 flash crash and buying aggressively if it happens. If a margin hike comes Tuesday and silver tests $62, I'm immediately buying physical with a maximum $5,000 allocation. Why? Because $62 silver with an 18% Shanghai premium equals $73 actual physical cost in China. That means an arbitrage window opens, and historically, when the paper physical gap gets this wide, there's a violent snapback. This happened in 2011. Silver crashed to 20 sclars on paper, but physical premiums were $8 to $10, and it touched $48 3 months later. I don't want to miss that opportunity. Now, let me give you the bull case, because to make informed decisions, you need to understand the downside, but you also need to understand why the fundamentals are still intact. Fundamental number 1. This is the 6th consecutive year of a supply deficit. The silver market has been in deficit continuously since 2021. 2021 deficit, 50 million ounces. 2022 deficit, 80 million ounces. 2023 deficit, 142 million ounces. 2024 deficit, 180 million ounces. 2025 deficit, 215 million ounces. 2026 projected deficit, 67 to 245 million ounces, depending on the source. Cumulative 5-year deficit, 667 million ounces minimum, and potentially 900 million plus ounces. This silver has been permanently consumed in solar panels, electronics, EVs, AI data center nuclear reactors. The recycling rate for silver is only 15 to 20%. The other 80% goes to landfills. That silver will never come back to the market. Fundamental number 2. New mine supply takes 5 to 7 years. If a new silver mine is discovered today and $500 million is invested in exploration, permitting, and construction, the first ounce of production will happen in 2031 to 2033, 5 to 7 years minimum. And there have been no major new silver discoveries in the last 3 years. Existing mines are depleting. First Nilo guidance, down 9% for 2026. First Majestic guidance, down 11% for 2026. Pan American Silver, flat to slight decline. The supply side is not getting fixed short term. Fundamental number 3, solar demand is structural, not cyclical. In 28-26, the solar sector is consuming 29% of industrial silver demand and growing at 14% year over year. Every solar panel uses 20 grams of silver. There is no substitute in current technology that matches efficiency. Global solar installations target for 2026, 500 plus gigawatts, which translates to 150 plus million ounces of silver demand annually just from solar. This demand is recession-proof because it's driven by government subsidies and climate mandates, not consumer spending. Fundamental number 4, China controls the supply chain and they're restricting exports. On January 1st, 2026, China added silver to the rare earth export control list. Now only 44 state-licensed firms can export refined silver from China. Everyone else is banned. China controls 60 to 70% of global refined silver exports. And China itself is buying at record levels, 8-year high imports in January to February 2026. When the largest exporter becomes a net importer, Western supply chains collapse. This is exactly the scenario that's playing out right now. Fundamental number 5. Institutional targets are unchanged despite the crash. This is the most important point. Deutsche Bank target, $100 per ounce unchanged. Bank of America target, $135 to $329 per ounce unchanged. Citigroup target, $150 to $170 within 3 to 6 months unchanged. Reuters, 30 analyst median, 79.50 for 2026 average unchanged. CoinCodex year-end model, 104.41, last updated April 10th. Not a single major institution has lowered their forecast despite silver being at $72 right now. Why? Because the structural case is intact. The deficit, the COMEX squeeze, China buying solar demand, Mexico tariff risk, the sulfuric acid ban. Nothing has changed fundamentally. The paper price is short-term noise. Physical fundamentals are the long-term signal. From right now until Wednesday evening, there's a critical 72-hour window where 4 major events could happen that will completely change silver's trajectory. Event number 1, Iran's first response to the blockade in the next 12 to 24 hours. The IRGC warned they'll use severe force if U.S. warships enter Hormuz. USS Frankie Peterson is already active on mine clearing. If Iran fires on a U.S. vessel, war resumes instantly. Oil hits $130 plus. Silver tests $65 the same day. Watch CNN, Reuters, Bloomberg terminals closely. Event number 2, PPI data released Tuesday, 8:30 a.m. Eastern Time. The March producer price index releases Tuesday morning. February, PPI was 0.7% month over month versus 0.3% forecast, double the expectation. March energy prices, gasoline up 21.2%, fuel oil up 44.2%. If March PPI prints at 1.0 to 1.5%, Fed rate cut expectations are completely dead. Silver could test $68 to $70 by Wednesday. I'm setting an alarm for 8:25 a.m. Eastern. Event number 3, Section 301, Mexico deadline, Wednesday, April 15th. The U.S. Trade Representative's public comment period closes on the Section 301 investigation targeting Mexico on Wednesday. If the investigation proceeds to tariffs, 25% of global silver mine supply is at risk. Fresnillo and First Majestic have already cut guidance. Tariffs would be the death blow. The public hearing is scheduled for May 5th, but Wednesday will make the direction clear. Event number 4, CME margin decision Tuesday evening. Historically, CME announces margin changes Tuesday after market close, effective Wednesday close. If there's an 18% to 20% hike, forced liquidation will happen Wednesday to Thursday. Silver could go sub $70. I'm monitoring the CME group website from 4 p.m. to 6 p.m. Eastern Time. So here's the complete picture. April 13th, 2026, the day the blockade went live. Silver is trading at $72.69, 37% below its January all-time high, while simultaneously in its 6th consecutive year of supply deficit. Oil is at $105. Inflation is heading to 4% plus. The Fed will not cut. The dollar is strengthening. And paper silver is crashing. But Shanghai is paying an 18.72% premium. COMEX inventory is down 75%. China is restricting exports. Solar demand is growing 14%. And institutional targets are $100 plus. This divergence is not sustainable. History says physical fundamentals eventually win. The question is only timing. The April 20th oil cliff is 7 days away. The April 22nd ceasefire expiry is 9 days away. PPI data is tomorrow. The Mexico deadline is Wednesday. The next 72 hours will determine whether silver goes to $65 or $85. I'm holding physical. I'm watching $70 support. I'm dollar cost averaging into miners. And I'm ready for a $62 flash crash with maximum buying power. This is not financial advice. This is information to help you make informed decisions. Check the data, understand the risk, and make your plan. Because when physical shortage meets paper manipulation, the most violent moves happen, and only the people who are prepared survive. I'm John. This was the April 13th Silver Blockade emergency update. The next 72 hours are critical. I'm monitoring. You should too.